And so return factor is one. So you could actually allocate a decent amount of capital. They are diversified pools of investments, and they kind of have limited variance or dispersion in their outcomes, and they provide solid double-digit returns over long term. The nuance is that it takes a bit longer, 1 or 2 years longer than a typical venture fund, but again, that's the name of the game, and they typically have few tools in their toolbox to overcommit, to take out some credit lines, etc. So they're solving for that for their investors. And the other element that is also adding ton of value is having them as sparring partners and understanding how they think, how they underwrite, what's their process, what tools are they using, and not like copying, but just trying to understand what works best for your own platform. And also the pipeline generation of ideas is also critical for investors like ourselves.
Here's a few words from our beloved sponsor. If you're looking to meet key players in Central Eastern Europe's private markets, this is the conference you don't want to miss. Join us for the 14th edition of the premier networking event for emerging Europe. You'll meet investors from firms like Antenna Digital Ventures, EBRD, EIB, Erst Group, IFC, Tibus Ventures, and many more. Join 0100 Emerging Europe from May the 15th to the 16th in Budapest.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So welcome to the UVC podcast. Today, we're going to welcome Justinas Milasauskas, investment manager at Willgrow. I'll ask Justinas to talk a bit more about Willgrow and himself, but just, quick one-liner. Willgrow is based in Lithuania. Within venture, they're focused on the early stage. They invest most of their capital in the US, 2/3, and then 1/3 in Europe. And I thought it would be really cool to have Justinas on the pod because, here we have a European LP allocating in the asset class. And, it's always interesting to hear their thoughts, how they build their own firm as well, and how they think about different types of GPs out there. So, Justinas, first of all, welcome to the show. And secondly, give us a quick intro on yourself and Willgrow.
Hi, David. Great to be here. Thanks for inviting. And we're happy to share a bit more about myself and Willgrow. So Willgrow is a first-generation single-family office based in the Baltics. We're set up in Vilnius, Lithuania. We have 2 operating businesses in logistics and real estate, and the family office has been set up nearly 10 years ago. So today we have 5 people on investment team, focusing on private markets globally, venture, buyouts, credit, and real assets predominantly. On venture side, I think we're uniquely set up given our long-term 25% target allocation to the asset class, so it shows our strong and long-term commitment. And we invest in venture by managers, primary commitments to venture funds. We can also do a bit of co-investments or secondaries, etc. But 80-90% of our focus is to selecting the best managers globally. At Willgrow, also, we are benchmarked, investment managers are benchmarked on a global scale. So we can select funds basically anywhere in the world. But given that venture ecosystems are largest in the US and Europe, setting aside China, given the macro context and political context, we predominantly focus on these 2 large geographies. So in terms of my background, I've been in finance for more than 15 years as investment management, investment banking and trading roles. Before Willgrow, I was part of another family office in Lithuania, and before that, I was on investment management side for fixed income and equities. So I've basically covered most of the asset classes over 15, 16 years of my career, and currently working for Willgrow over the past 3.5, 4 years.
Justinas, one question, because as you mentioned, right, Willgrow's been around for a decade or so, and the venture kind of mandate is more recent. Do you have any insights you can share on that process? Not only the setting up of it, but the maintaining it. And the reason I ask is, recently I've had many conversations with sometimes it's families, sometimes it's more corporates, but kind of they're going through this process of thinking about venture for the first time. And oftentimes what I find, there is like one or two internal sponsors, internal people they have to convince. So it ends up being quite a complex process as well. So wondering if you have any insights you can share on navigating those complexities, right?
Absolutely, that's a great question. So when I joined the firm nearly 4 years ago, with a mandate to build out the program, we basically faced the same topics and questions. But I guess I was very lucky to be in a good spot where the principal of the family office wanted to do even more venture than we have now. So my objective was to pull out the long-term, return data and show that venture may outperform if done well, but it's not like 2x the buyout or public market type of return. So we have to be well diversified, and we looked at allocations of the major endowments, prominent family offices in the asset class, and basically came up with the top of the range target for our program. So it was a great consensus from the perspective of the program, myself, and from the principal, where we have a substantial exposure, but it's well diversified within other asset classes, and does not put too much risk on the overall portfolio in the long term. And we are still in the process of building it out. We're nowhere near the long-term targets, so that's great, and that keeps us super busy. And we gradually doing that every year in a very similar cadence, and we've been very lucky with timing. I would say we started venture build out in 2021, so ideally we should be allocating a bit more each year, given the recent tech reset.
To the emerging GPs listening in, that's good news. Means Willgrow is on the hunt. And so if you fit the profile, you should definitely reach out and see if you fit the portfolio they're trying to build out. Before we dive deep into venture specifically, I want to ask you a follow-up question to that. And you briefly mentioned it. So you mentioned benchmarking as an example. But when you think of, as Willgrow, right, when you think of the split across asset classes, and you mentioned 25% roughly for venture, what do you think are the key levers here that you need to take into consideration? I think benchmarking is one you spoke about. It's quite obvious what that is and it means. What other levers are there out there?
I think even before benchmarking, I think you have to really build a convincing strategy for sourcing, because if you don't source well, benchmarking would not matter. In order to have something for benchmarking and sort of had a reasonable chance to deliver alpha in whatever sense of the word, you have to have a reasonable and measure strategy for sourcing and also for portfolio construction. So when we started, we said, okay, let's have 3 avenues for that. So one is we are always on the road with the hunter's mindset, networking, going to US, Europe, meeting other investors, etc. So that's our, let's say, the hustle part. Then we gradually realized that we need to have 1 or 2 senior advisors at Willgrow for venture, but not only for venture, but also for other asset classes. So venture was the the first program that utilized the senior advisors for the benefit of the family office and for the program. So they bring a ton of experience, open up their networks, and help you avoid stupid mistakes. So that's avenue number two. And the third path was invest in a handful of fund of funds, because I think fundamentally fund of funds have the most challenging business model to justify the fees on fees, etc. And then at the first instance, when you have a dedicated team in-house, fund of funds might not make that much sense. But if you think holistically for the long term and you want to back the best managers, that could be the most important avenue for investors like ourselves, who are based outside of a typical financial center and who have very large allocation to the asset class. So fund of funds are amazing partners, and they are partners in several sense of the word. So they actually deliver great returns if you look at any data set. So we took PitchBook and Preqin and looked at long-term and medium-term type of returns. And you also, when you map the market, you get a lot of data rooms, so you see that firsthand as well, not only via third-party data. And we noticed that their returns have been amazingly consistent and in sort of second quartile. Of course, we're talking about great fund of funds, that have been established for a number of vintages and with very strong teams. But there was also proliferation of emerging fund of funds, which we also backed because of various reasons and the various advantages that they had and brought to us. And so return factor is one. So you could actually allocate a decent amount of capital. They are diversified pools of investments, and they kind of have limited variance or dispersion in their outcomes, and they provide solid double-digit returns over long term. The nuance is that it takes a bit longer, 1 or 2 years longer than a typical venture fund. But again, that's the name of the game. And they typically have few tools in their toolbox to overcommit, to take out some credit lines, etc. So they're solving for that for their investors. And the other element that is also adding ton of value is having them as sparring partners and understanding how they think, how they underwrite, what's their process, what tools are they using, and not like copying, but just trying to understand what works best for your own platform, and also the sort of pipeline generation of ideas is also critical for investors like ourselves.
Yeah, I like what you're saying in the sense that as you said, like the best fund of funds can deliver fund-like or VC fund-like returns. They need a tiny bit more time, but it's also the best, right? It's not all of them. And I think it's cool that you double click on that, because we hear a lot this this discourse of downside protection in fund of funds, which is absolutely true, right? But that doesn't mean they necessarily perform every single fund of funds out there. So thank you for saying that. Before we move now into the interesting part, in my view, because I'm a venture geek, can you just put some words on to kind of categorizing the type of LP you are? And by that I mean ticket sizes, type of GPs you want to back. We know Geo already, but also do you have only financial objectives as you invest? Do you also have strategic ones? How active or passive do you want to be? Just a few words on that for everyone to understand your approach.
In a nutshell, I guess what you're asking is what our investment strategy. So happy to double click on that from various angles. I think let's start from the top. So the way we look at the whole venture market, which is definitely not homogeneous anymore, and there are 10 million solo GPs and multi-billion multi-stage funds, which deliver a totally different profiles of risk and return, and cater towards totally different profiles of investors or ICPs from their perspective. So I will just talk from our side, and that's not necessarily truth as such, and the different investors might perceive things differently, and have preferences for different elements of the venture ecosystem. But from our side, so if we say pre-seed, seed, small managers, be it emerging or established, sub 150 or sub 200 million, we put them into one bucket. Then we say, okay, that there is space for, there are multi-stage managers, late stage, secondary diversified managers, fund of funds. They kind of belong to the lower risk, let's say, bucket, and then in between of those, there is a spot probably for mid-sized sector specialists, or sort of Series A type of funds, Series A specialists. So some sort of specialists in a sense, having 250 to, I don't know, up to 500, or sometimes a bit bigger in size. So then we say, okay, which areas we want to play and spend the most time, because we are two people on venture. You cannot equally and split and look at everything all at once. So we say, okay, given our risk profile, mindset, first generation entrepreneurship, things like that, we want to play in the highest risk bucket most of the time. And there is evidence that shows, if selecting well, this bucket should deliver biggest outcomes. And if it's diversified enough, the downside is reasonably well protected. So in a sense, building a fund of small, pre-seed, seed managers ourselves. So that's where we spend most of the time. We write, let's say, median ticket is 2 million in that segment, and it's agnostic in terms of sectors and geography. We operate in the mindset that best idea wins, and it can be Israel, it can be Europe, it can be US, or a manager. If we look at manager in Lithuania, we benchmark him or her to the manager in Berlin, New York, SF, and Tel Aviv. So it's just as simple as that. Again, reminding that we as investment managers at WillGrow are benchmarked globally as well. In terms of active or passive, I guess it's a combination. We're actively passive, so we, in terms of what relates to engaging with manager pre-investment. So it's I guess standard. Sometimes we have to be a little bit sneaky in a way that we know that the manager is in a very high demand, so we do a ton of work in the background by not, let's say, asking too much from that manager to partly differentiate maybe from other LPs and build our conviction quickly. We can double click on that later, but I guess it's a standard process before investment. And after investment, we call it post-investment DD. You're always in diligence before they come for fund 2. You should ideally, for the next fund, exactly. You should ideally have conviction already in place about that, the next fund. We typically commit to 2 vintages, so that's the modus operandi. But things might change, from our side and from the manager side, so which can be objective or subjective. But to wrap up on this, we do not disturb, let's say, managers too much. We let them focus on what they should be doing, and delivering returns for their investors, but we actively, reading their reports, discussing internally, going through some companies they invest, talking to other LPs, how they feel, and things like that. So it's active in the background. I hope that answers.
Yeah. I've described that approach as, in the lack of better words, I've described that approach as like extremely reactive, in the way that you don't ask much, but when they need anything, you're the first one to reply.
Absolutely.
Which I think is basically what you're saying, right? You don't want to be a burden, but you do want to be helpful when you can help, right?
Yeah, totally.
I love that.
It's like being just waiting for that email to come in and replying within half a minute.
Yeah. So any GP in Willgrow's portfolio, Justinas is looking at his email every day, waiting for your email to come in to help you out. Justinas, 3 biggest learnings in venture. Do you want to share that with us?
Absolutely. Although we're still emerging LP on year 4, or let's say in GP's terms, early innings of second vintage. So we still have tons of learnings actually, but to maybe zoom out and flag maybe a few biggest. So ticket sizing has been one learning for us, especially when we started in 21. It's just the sentiment was, the markets were public markets were already very fragile, but the sentiment in venture was still pretty strong, and the returns that we were seeing on this quarterly pitch book or pre-Queen benchmarks, you're just looking and you're thinking, hey, this is amazing. I still like, what can I do to jump on this train and catch some of these things for the benefit of the family office. We went in slightly too big at the beginning, so I think that should be great learning, and for people who want to start or are in the early process, it's best to do the opposite, start smaller and escalate sizes as program matures, because exit improves, knowledge improves, and it's much better. And the other learning is, I guess, proper benchmarking. So there were situations where we got excited about a particular manager, did a good, let's say, proper underwriting of that manager, referencing, etc. But it was selection, let's say 1 out of 1, if it makes sense. At least a rough or quick mapping of competitors, the sector and the geography. That's the learning, and we never compromise on this again. And it's just, this helps to build even more conviction, or on the opposite, you increase your chances of finding someone else who might be better in a similar domain. So it's basically win-win for you as investor. So you broaden your network, broaden your perspective, and increase chances of making a better investment decision. So that's the second one. The third learning has been to properly diversify within portfolio across funds and across vintages, timing-wise. So there was a period in our portfolio where we, let's say, skipped a vintage, so to say, or skipped a year, and I think it does not work for venture, especially for venture. And we've seen recently Stepstone published a paper where they argue and they collected data to show that there is a power law in vintage type of returns. So 3 vintages in the past 20 or 15 years generate 70-80% of their returns.
Yeah, I love that. I love that you mentioned that. And I think it's such an important learning for any new LPs coming to market, right? That consistency and thinking that you should be committing to every vintage. I have one question though. You mentioned in your first learning, which is ticket sizing, stay disciplined, do not overcommit. You mentioned that you came to this realization that you started a bit too big in the early days. It's really hard, I find at least, to kind of come to that conclusion in a fully data-driven way, because what is too big? Like, why is it too big? What does that mean even, right? Is that because you were more than a specific percentage of the fund size, or is that because you feel like because of your ticket size you could only do 2 managers instead of 4, right? What does that mean to you? How did you come to that conclusion?
The learning comes from 2 angles. One angle comes from the fact that we have operating companies. It used to be the case that operating businesses provide cash flow for portfolios. Now we're set up totally independently. Our projections or ambition for that cash flow to feed the investment program was too aggressive. And then with that in mind, you say, okay, 1 year from now, I'm like, my AUM is there. 2 years from now, I'm there. So in order to ramp up the program, and then the fact was that we were just starting, so you want to ramp up, and this combination made us overcommit. The other element, I think, when you start, you have to have some sort of end game or end shape in mind. And this end, I don't know, it does not necessarily have to be 10 years from now, or it can be 3 years from now. You say, okay, I will behave like, let's say, fund of fund. I'll have a 2-3 year investment period. How do I want my program to look 3 years from now? How many managers, how many line items, what's my diversification, etc. So then when you have this end status in mind, then you really understand what's your ticket size, how many shots on goal or do you have, and things like that. So we started with a pretty decent plan in terms of execution, but we lacked this sort of portfolio and vision of the final portfolio, at a certain cutoff point. And then we realized that okay, we might with this ticket sizing that we were writing, we might end up under diversified. So maybe it correlates to the first issue that I mentioned, but they both work in tandem, I'm sure.
And then another follow-up question. We actually had a really cool, every now and then we host these AMAs, Ask Me Anything, with LPs for our GP community. And yesterday we had a former investment manager at a pension fund, actually. And we ended up talking a lot about stack ranking, because, and the reason I mentioned this is because you mentioned one of the learnings, benchmarking, right? Never compromise on that. And if you pick 1 out of 1, you're taking a bit of risk there. And so oftentimes, you're stack ranking as an LP. That's the name of the game. You want to commit to early stage climate VC. Well, you go out, you meet all the ones you can find. You try to meet every single one out there, and then you stack rank. What would you say are the key elements there? And I appreciate it's a very complex question, because you have, to use my example, within climate, you have established funds, you have emerging funds, they're all very different, and you can't really truly stack rank. But how do you think about that?
Yeah, absolutely. So stack ranking is the core process for us every day at Willgrow, in venture or other asset classes, because I guess that's the only way to find the truth, or to build the great portfolios. And the stack rankings complexity lies in a number of factors, and I will share how we do it. So you have existing relationships, so that's one. How much more weight do they get? That's an open question. You have managers that they're currently raising, that you're looking at. You have managers that you have in the wish list that will be raising in a year or 2 years that you have no data on. So you'll know that you'll receive some data when they are back in the market. So how do you sort of reconcile that and then stack rank properly? And then with the, let's say, vintage approach, where you say, okay, my investment period is 3 years. I want to build, 15 to 20 fund relationships. How much space do you leave for year 3? With some data gaps, with like really proper data gaps in your stack ranking table, especially with the managers that you don't have any data on because they're not in the market. And then the fourth element is that will you have access to all of them? These are the nuances, but I think it's a core process for every professional LP to always stack rank, and that's what we do. So we have a wish list of managers that we want to have to get introductions, warm intros, or find any ways possible to start conversation at any point in time. So that's one. Then we have watch list. So that's a list of managers that we either asked and we were very, very close to committing. So we just, they're always on the radar. We keep in touch. That watch list also includes managers that we didn't get access, or maybe we were too late in the process, which is, pretty natural in venture, especially when managers raise in a month or two, and then you just happen to meet them, 2 days before final closing. That unfortunately happens. And then the managers that you met, you liked, what you've heard, and they will be back in the market in the next 2 years. So this is the watch list. On the other hand, we have existing relationships. We have the watch list relationships, or cold relationships, or warm relationships. And then we have a 3-year investment period. We put all existing relationships when they will be coming back to the market next time in these 3 years. Then we stack rank all the watchlist funds and then place these top 10, let's say top 15, whatever the gap is left. We are doing assumption that we're re-upping in all our existing relationships, unless something dramatically changes. And then we fill the bucket, all the buckets with the watch list managers. And then we just, when managers come to the market, this list becomes live. Okay, watch list manager comes to the market, we see the data room, or there are any other subjective reasons, it's unfortunately we don't commit, then this spot being taken by somebody else from the watch list, or if there is something with the existing relationship and a spot becomes available, then that's how it kind of works. Long answer to your question.
No, good one. Very transparent on your process, and I think it's interesting for GPs to hear this as well, because this is what happens inside closed doors, right? This is what you're going through in between commitments, and when managers aren't in the market, but you might do a catch-up call with people. You're managing these different buckets internally and thinking about it and stack ranking, right? Yeah, that's super important, I think.
Every AGM, every call, every newsletter, quarterly update from watch list or existing relationship impacts stack ranking. So I should probably have said that.
It all the time. Yeah. No, but of course it does, right? Of course it does. It's your input for your decision-making processes. Anyone listening attentively will have noticed you said a couple of things a few times about gaining access, not having access, fighting to get access. And so we're really talking about accessing allocations. We all know that there are funds out there in the market where, well, it's really, really tough to access, right? Where when they come to market, even existing LPs might be squeezed, not out, but their allocations might reduce because they want to bring in another LP. And this is where your special sauce as an LP, let's put it like that, really matters, because it's the way you get to gain access, right? And as you said, you see Willgrow and yourself as an emerging LP. So I'd love to just open up the topic of, how can emerging LPs overcome these barriers of access? And do you have any tips or strategies that you personally have found work really well?
It's actually incredible. So my background has been in public markets, both on equities and credit, and I've never dealt with access issues in my life. You can buy stock or a bond, whichever you want, based on relative value and your best research, etc. And then you start doing venture, and and you realize that investing capital does not necessarily lead to someone accepting capital. So that was an incredible learning for me personally. To answer, I think every professional LP is dealing with this to a smaller or larger extent. And I guess if you are a large one, you have less constraints in terms of access to multi-stage branded firms. But on the other side, you just can't access small, nimble, emerging GPs because you're just too big. So it's another side of this coin. So I think we are, in a way, almost ideally positioned in terms of ticket sizing, writing 2 to 3 million checks for pre-seed funds, 5 to 10 million checks to Series A or multi-stage funds. Some of them might have a bit bigger minimum requirements, but we can grow our tickets over time. And then with this long-term commitment, it helps to illustrate that long-term commitment to the asset class. So I already started to giving a little bit of, let's say, marketing points from our side, but I think first and foremost, it's building conviction and strong conviction early from our side. So if you have conviction, this process becomes so much easier. We never chase brands or celebrity GPs in whatever sense of this word, just for, let's say, having a logo. So this would be a relatively low conviction exercise for us. So we try to underwrite properly as much as possible with various data points or LP to LP type of conversations as much as possible in advance. So this is on us. Then if, let's say, we have a 80 to 90% conviction just before they start fundraising, then the remaining 10 to 20% should be confirmed after collecting all the data when they start the process. But with this already a head start, what we need first access is to get opportunity to see them in person and align on the vision of their partnership, of their firm. So we need to understand where are they going, what is their strategy, how does that look, how does that partnership look 5 to 10 years out. And then, with our high conviction and alignment of vision, I think we're in a good starting point. I think it's still a starting point. So alignment, background diligence, then I think we're, again, to reiterate, ideal in terms of ticket sizing. We're not too big, we don't squeeze too many other LPs, so to say. If their fund size moderately grows, we can be sort of convenient LP from that side. Also, what I noticed that GPs, especially in the US, they appreciate the diversification of their LP base, not only by type of LP, but also geographically. So this element also works in favor of the GP, that we can bring diversity, having operating businesses in certain segments, having geographic exposure, having a sort of entrepreneurial mindset. We are also pretty well networked in the family office and let's say general LP space, both in Europe and the US, and this also works as a good argument of where we can add value, not only by leveraging our, let's say, operating companies and supply chain and logistics and real estate, but also connecting to fellow LPs, let's say in Europe, in Central Eastern Europe or Baltics, depending how the GP wants to diversify or where is looking for new potential interest. So this would be, I guess, this would be the combination of factors. None of them as a single factor is probably the key, but all of them together, I think, work pretty well for us to gain access into relatively tough situations in terms of supply demand for a given manager, and also I think in the past 1.5 to 2 years we actually never had a problem to access a manager. So I'm super glad that this strategy actually works well, and we hear more and more positive feedback from GPs and engagement and access is not actually becoming a big constraint for us.
I like how you're flipping the script on its head by saying, being based in a peripheral country, so to speak, for the venture ecosystem might actually be an advantage here, right? Especially as they think of diversifying their LP base. And to be very, very transparent and frank with you, what you're saying resonates a lot. We also do our small LP tickets, and we've managed to access some, let's call them access constrained funds or high profile funds. And I honestly believe it's because of some of the things you said. It's alignment, it's relationship as well, right? It's as little friction as possible and just being an easy LP to deal with. Like, I think that's so underrated. Like, it's so important, just being an easy LP to deal with, that is just, friendly, helpful, and not asking for too much as well. I think it's highly valued by many of these GPs, especially if there's then some kind of alignment. You mentioned alignment, a vision of the partnership. That's one type of alignment, but you can take that even broader if you want. Thank you for sharing that. I appreciate that. We're running out of time, so I want to make sure we cover two last things. One is my favorite question, actually, which is, what is a strongly held belief you've recently had to change your mind on?
Actually, I mentioned this one, and this is related to funds. 3 years ago, we had a totally different imagination of the role and the value of fund of funds, and we were flexible enough, and I'm glad we spend more time on this topic, and we actually changed our minds. And as I mentioned, we backed few fund of funds. I think 4 to 5 fund of funds on our platform. Maybe 5-7 years from now, we have maybe 2-3 fund of funds, but it's still an integral part of our program for the benefits that I mentioned earlier for being a sparring partner and also delivering returns.
Yeah, I like that. I think that's a really nice message to end things on. And then the final question, non-venture related. What's the last book you read that truly inspired you?
Recent book that I really liked, and it resonated very well with what we do on a daily basis, has been Leading by Alex Ferguson. It's a lot about football and the backgrounds of scouting players and then sort of managing teams and other challenges and running big organizations and moving, upwards the career ladder from smaller teams like Man United. And I guess the key element that resonated super well with me was the incredible ability by Sir Alex to scout players globally and snatch them with the, let's say, limited budgets that the team had back in the day, from in front of the other favorites like Spanish or Italian clubs that had more money. So this scouting, hunting, hunters mindset, flying to meet the player next day, and hustling resonates super well with us. That's exactly what we do. We can have a call with the manager and meet them next week in person and sign the sub docs in after next 2-3 weeks. So that's kind of our approach as well.
I like that. That's cool. Justinas, I want to thank you for making the time to join us here on the UVC podcast, and also for being so transparent with sharing the way you and Willgrow think and allocate to venture. Thank you for joining us. To everyone listening, if you enjoyed the episode, drop us a review, follow the pod, and subscribe at eu.vc.
Thank you, David.
Here's a few words from our beloved sponsor. If you're looking to meet key players in Central Eastern Europe's private markets, this is the conference you don't want to miss. Join us for the 14th edition of the premier networking event for emerging Europe. You'll meet investors from firms like Antenna Digital Ventures, EBRD, EIB, Erst Group, IFC, Tibus Ventures, and many more. Join 0100 Emerging Europe from May the 15th to the 16th in Budapest.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.